Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Good afternoon, everyone, and welcome to another episode of Reynolds Wrap. Joining me, of course, is Cory, Stilp, my good friend and business partner.
Thanks, Don. Welcome, everyone.
So today we're going to talk about, basically, it's holding money versus contributing money, dollar cost averaging versus distributions, and the cause and effects of how that works.
Yeah.
And it's, again, I know a lot of people have heard dollar cost averaging. There's no question that's the best way to do it. So what we want to do is kind of start out, let's say we'll go back to 2000, for example, and we had $500,000 and we did nothing with it, but just left it sit in the market and just rode out the waves, so to speak. And so 20 years later at the 2020, your $500,000 would be worth about $1.5 million. Now, that's not a bad thing at all. We get that. But if you remember the first 10 years from 2000 rather to 2010, they were pretty flat. Not a whole lot happened in the markets. Some people call that the lost decade. You've maybe heard that in the past. Whereas, say you started in 2000 and you just started putting $25,000 a year away, so you invested over that same 20 years, the same $500,000, you would have $2 million in that account. So that's a drastic disparity when you think about it. And it's all because of dollar cost averaging.
Yeah, absolutely. And using the S&P here as a benchmark, if you will, on some of these numbers from that period of 2020. And really what we're talking about is the key category, if you will, or summarizing would be the direction of your money. So if you take your dollar, are you putting $1 away every month into an investment? Or are you waiting until those dollars add up to be a certain lump sum and then dumping the lump sum in for that investment? Or a third situation would be, as we've talked about in the past, are you taking $1 away from your investment every single month in distribution? So those are the three high-level, directions of your money and where the dollars are going. Don, of course, spoke to waiting till those dollars add up and have a lump sum and putting them in an investment, as compared to averaging that out or putting $1 in per month over that same time frame. What I'd like to kind of end with or talk a little about here is the distribution of that. We've had many episodes where we've talked about sequence of return risk, or a recent episode here where we looked at taking volatility away and what that can mean when you're taking money away from your assets, called the distribution phase. So in this same example, as we are highlighting today, from that year 2000 till 2020, if you had an account balance of $500,000, but you were taking distributions from that account, and what we're using is an RMD, or required minimum distribution at that point, which is about 4% we're using. In that same time frame, using S&P again as a benchmark, you would have less than half of that value available to you as a lump sum or in that account balance, because of, again, taking money away while we're having those years over that time frame with the market going down, and then not having those shares or that investment to recover when the market comes back up. So again, direction of your money is a key component, not always just seeking high returns as you get into or near retirement.
Exactly. That's where, when we talk about the distribution phase, because we know you lose control, IRS mandates take money out. And that's where we talk about making sure you have a solid income plan in place. Everything we do for our clients, that's really the benchmark. That's where we start. We want to make sure there's enough income coming in the door between Social Security, pensions, whatever it has, to meet the obligation or the budget that people provide to us. And so, again, it comes back to what we, in one of our previous episodes about volatility. You really want to get rid of that in retirement, and you want to have sustainable income that you cannot outlive. And also potential to have that income increase over time, because we know inflation's here. It's not going away. It's been around for 100 years or more. And so I think it's important to understand when you start retirement, you need to have something structured of income that's guaranteed for both lives, for husband and spouse. Because as we talked about in the past, one passes, well, some of the dollars walk out the door. Social Security for sure, the lowest one, potentially how pensions are structured. You may lose half of it or maybe all of it. So it's imperative to look at the long-term effects of these things. And I think that's where Cory was talking about the direction of the money and how much difference it makes when you start with a zero balance and over 20 years, put 25,000 or 25,000 a year over 20 years, you put $500,000 in there, but you have $2 million versus starting with $500,000 and 20 years later, you have $1.5 million. That's the power of dollar cost averaging.
Yep. And that again can work to the contrary when you're taking those distributions. And that's called that sequence of return risk. So again, we used to call it mailbox money years ago when we'd get a check every month in the mail and have to take it to the bank and deposit it. Of course, those days are gone now, thanks to technology. Now it's an ACH deposit, typically just automatically deposited in your checking or savings account. And having that stability and having that check come in every single month really frees up and gives you freedom now. You bought time back on some of your other assets. And I know our clients can appreciate how we draw this out and show you exactly how this can work when we look at your total asset pool. So again, we'd love to have you in and go through this in person with you, show you the charts, look at your numbers and give you examples in different time frames. We've got software that can show you that. Please do give us a call. We'd be honored to have you here for a discovery meeting. No cost, no obligation, no strings attached. And our phone number is 651-773-3859. Again, 651-773-3859.
Very good. Well, with that ends another episode of Reynolds Wrap. We appreciate your time, and we're hoping you're bringing some value to you folks. And like Cory said, feel free to give us a call if you'd like to meet with us. Have a great afternoon, folks.
Thanks, everyone.
Listen to more with Don Reynolds and Cory Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.